Sven, I think everybody sort of understands what you're referring to. I guess the question would be how long you think that dynamic lasts.
Yeah, hi, Carl. Look, it's really interesting what's happening on that front because even yesterday morning, before market opened, the S&P futures made a new all-time high. Today, the Russell small caps was down 14%. So it just speaks to the raging pain that's actually underneath. So I'm actually left with a conflict in the charts because I see a lot of signal charts that are massively oversold, like we just had a major correction, and we did underneath. So you can make the case, maybe this all settles down here after OPEX today, and we can have that kind of year-end rally because a lot of tax loss selling has taken place. So I'm looking at positive divergences in some charts like small caps or semis, and then make the case for that. The larger issue is the market is still massively dependent on the generals, the top cap tech stocks, not rolling over in a big way. Today, as we're speaking right now, the NASDAQ 100 has held its trend, so that's for now positive. But if it loses that trend, obviously more pain ahead, maybe early in the year when maybe there are incentives for people to lock in some of the profits on the winners that they so far have held off on taking.
Right. I was going to ask you about how that sets up a January playbook and whether or not the January effect will be valid in 2022, and also how much depends on how quickly Omicron burns off, if in fact that's what happens.
Yeah, look, I'm not a medical expert, but it looks like it may be burning off hopefully early part of the year. I think the question still remains about the impact of incremental liquidity. My contention all year has been the Fed's balance sheet expanding. That's kept the indices up. Obviously, liquidity predominantly flowing into the big stocks. And as that is coming off, past history shows up when QE ends somewhere, markets take a hit. And so the risk is that, the overall indices is still dependent on these large cap stocks.
Yeah, Sven, you've been tweeting your theory that the S&P 500 is nothing but a Fed balance sheet tracker. With that in mind, what do you anticipate in terms of how the market's going to be reacting to those Fed movements next year?
Well, look, go back to 2009. Every time the Fed ended QE, be it QE1, QE2, or what have you, they were forced to go back into it. And it's not only the Federal Reserve, it's the global liquidity equation, because during this time period when they were able to roll off their balance sheet minutely so by $700 million, they were able to do it because the ECB and the BOJ kept printing. So I think everybody has to reassess now, because this market has been so dependent on this liquidity flowing in, and now it's coming out in a quick way now. There is definitely risk for larger dislocations in the early part of the year, and I think we'll all have to assess the impact as it unfolds. And I think ultimately what it comes down to is, we're talking about rate hikes for next year, which the Fed is now actually forced to do because of inflation still being predominant. We have yet to see a Fed react in any follow-through way in a hawkish side when equities are dropping. So I think this is going to be the big gaming exercise of next year, between maybe inflation peaking and coming down vis-a-vis how equities reacting to less liquidity coming in.
Yeah, not to mention the disparate playbooks we appear to be getting from the big central banks around the world. That'll be a discussion for next time. Sven, appreciate it very much. Have a good weekend.